Are you ready to seize the opportunity to grow your wealth in 2025? Don't wait until it's too late. If you continue with the same old habits of working for a paycheck, saving every penny, and hoarding cash in the bank without using it, you're essentially helping someone else pay off their debts. Not only that, but you're working hard to earn money, only for that money to be used by someone else to spend it freely. In the end, they get richer while you get poorer. Why is this happening? Because the financial world is shifting, and once again, those who simply save will face the consequences. This doesn't just apply to you, it's happening to everyone. Over the past 4 years, you might have noticed that even if you didn't buy rising U.S. stocks, the value of real estate in the U.S. kept increasing. Even if you did nothing but keep money in your savings account, you'd still earn 4 to 5% interest annually. Imagine, if you're from Japan and exchanged all your yen for dollars, your wealth could grow passively by 50%. Here's the kicker. If you converted all your money to dollars, bought real estate in the U.S., and used that property to take out a mortgage to invest in U.S. stocks, then reinvested in a savings account with a fixed interest rate, you would have maximized the returns on the U.S. money supply from the past few years. But starting this year, this method will change. Over the past 4 years, the Biden administration has raised interest rates to draw dollars from all over the world into the U.S., increasing asset values. However, under Trump's potential return to power, the strategy could flip. His administration plans to cut interest rates, devalue the dollar, and drive government spending in a more reckless manner. Recently, he even announced his interest in purchasing Greenland. But where will the money come from? In our previous discussions, we saw that most global funds have been flowing into U.S. stocks rather than government bonds. This means those who own stocks, capitalists, are profiting, while the U.S. government, which issues bonds, isn't. For example, Warren Buffett can sell stocks and keep the largest cash reserves in history, while the U.S. government only has about $7 trillion in its treasury. But every month, government spending exceeds income by $200 billion, and at this rate, the treasury could be drained by around April or May this year. But don't worry, the U.S. government never runs out of money. They have a backup plan. The Federal Reserve prints more dollars and buys U.S. government bonds. This is what happened in 2009 with $2 trillion, and again in 2020 under Trump with $5 trillion. Each time money is printed, the value of the dollar decreases, leading to inflation. Let's say I borrow $10 million from a bank. When inflation kicks in, I still pay back the same $10 million, but the actual value of that amount has decreased to $8 million. Similarly, if you keep your savings of $10 million in the bank, its real value will also shrink to $8 million. The $2 million difference? That's money you've unwittingly handed over to someone else. Essentially, you're helping someone pay off their debt without even realizing it. Right now, the U.S. is in over $30 trillion of debt. How will they pay it off? By using this very strategy. If you lend the U.S. government $10 million for 10 years, in the end, they'll pay it back. But the real value of that repayment will only be $8 million. This means $10 million used to be able to buy a mansion, but now it only buys a regular home. So, if you're just earning money and leaving it in the bank without putting it to work, you're unknowingly giving it away. If you want to protect the money you've worked so hard to earn and not fall victim to this game, or even use this opportunity to grow your wealth and overcome societal barriers, stay tuned to my channel. I'll be sharing more tips with you. To start, everyone needs to prepare mentally because printing money is becoming a regular occurrence. In the past, this happened once every few decades, but now it happens every 3 to 5 years. This means we need to prepare for high inflation from this year onward. I was taught in college that when the economy is growing, we should buy stocks since companies will profit, causing stock prices to rise. When the economy slows, and companies start losing money, we should shift to safer assets like U.S. bonds, which are considered the safest in the world. Think of it like lending money to the U.S. government, with the guarantee that, as long as the U.S. doesn't go bankrupt, you'll get your money back. However, if you look at U.S. 10-year Treasury bonds, you'll notice that their value has been rising consistently for the past 20 years. This changes the traditional wisdom, as U.S. bonds have become an asset for speculation, similar to stocks, because their price keeps going up, despite low interest rates. For example, in 2020, during the most chaotic market period, the interest rate on U.S. bonds was below 1%. Yet their value reached a historic high of $140. So, if you bought a bond for $100 at a 1% interest rate, you'd earn $1 in interest every year. But because the price increased, you would have to pay $140 to buy that bond back, despite it still paying only $1 annually. Essentially, your return on investment, ROI, would be less than 1%. Yet, over the past 20 years, countless people have bought U.S. bonds for this reason. The increase in their value made them an attractive investment. People were speculating that the price of bonds would continue to rise, especially after the 2000 dot-com bubble burst. The Federal Reserve cut interest rates 11 times in a row, and bond prices skyrocketed, especially after the 2008 financial crisis. So, while U.S. bonds were once a safe bet during tough economic times, they've become a vehicle for speculation. People buy them not only for the safety, but to profit from the rise in bond prices. If people stop spending, the government might print more money to replace the spending gap. This leads to lower interest rates and triggers inflation, making everything from food to rent more expensive. As a result, you'll be forced to spend your money now because in the future, it won't stretch as far. Inflation drives people to consume and invest, which gets the economy flowing again, and salaries could rise. But does it really work like the theory suggests? When prices go up, does your paycheck keep pace? Even if wages do rise, will they keep up with the speed of inflation? Think about those who could have bought a house 10 years ago but didn't. How many would still be able to buy one now, with the unlimited money printing? In theory, when more money is injected into the economy, it should help. But in reality, most of that money ends up being loaned out at low interest rates, benefiting big corporations. These corporations use the funds to drive up stock prices, attracting small investors. Eventually, they sell off stocks or engage in short selling, pulling their profits back safely, while waiting to buy back at lower prices. This creates a cycle where the stock market becomes a tool for the wealthy to transfer assets from hard-working individuals into their pockets. This is how the U.S. builds wealth, by shifting and seizing assets, not necessarily creating new ones. Japan, on the other hand, is a different story. Not only did they pioneer money printing on a massive scale, but they also dropped interest rates to a negative 0.1%. What does that mean? If you deposit 1,000,000 yen in a Japanese bank, after a year, you'll only have 999,000 yen, because instead of earning interest, you're charged for account management. This seems absurd, right? So, why doesn't Japan experience inflation? This is where the U.S. financial system plays its part. While Japan prints money and lowers interest rates, the money doesn't stay in Japan. It flows to the U.S., where capitalists borrow it at low rates and invest in U.S. assets, making money off the global system. Meanwhile, in Japan, inflation isn't an issue because the money isn't circulating locally. This is why Japan's assets don't inflate as much as U.S. assets do. The U.S. has its own set of problems. The massive debt and the constant printing of money could lead to a situation where the dollar and U.S. Treasury bonds lose value. So, how does the U.S. continue to get away with it? Japan's role is crucial. When the U.S. faces a financial crisis, capital from U.S. investors flows into Japan, inflating the value of the yen and Japanese assets. Once U.S. assets are undervalued, they buy back into the U.S. market, driving prices up. This all paints a picture of how the U.S. continues to play the global financial game. But the risk is real. Even with all this manipulation, the U.S. is facing challenges. U.S. bonds are becoming harder to sell, and countries like China and Japan have reduced their bond purchases. The Fed may need to print even more money to keep the economy afloat. In short, the U.S. is walking a fine line, and the speed of money printing is only accelerating. The value of the dollar could continue to slip, and inflation will likely follow. So while stocks or bonds may seem safe, maybe it's time to consider something like gold, which the Fed can't just print out of existence. With gold, you're investing in something real, something that's historically held value, even in the toughest of times. If you believe that the US dollar will gain value in the future, then gold may not be the best choice for you. In that case, you'd need fewer dollars to buy more gold. But if you're like me and believe we're heading into an era of significant inflation, with the dollar continuously losing value, then gold is one of the best hedges against that risk. In the future, you'll likely need more dollars to buy even less gold. For me, once I reach $1 million, I'd invest a portion of that into gold as a long-term safety net. Sometimes when gold enters a strong upward trend, like at the beginning of last year, I might also consider investing in gold ETFs or use leverage to trade futures contracts to take advantage of short-term gains. But in the long term, gold is one of the few assets that has consistently shown the potential for explosive growth. The risk of buying gold is relatively low, but once the price starts to rise, there's really no ceiling. That's the kind of risk-to-reward ratio I'm after. Some people live to sleep soundly at night, while others live to be awake and alert. Right now, things may seem calm, but we all know that's usually the calm before the storm. In fact, the U.S. stock market has already started entering its second round of corrections. As we head into a volatile period, things are likely to get even crazier. But for us investors and entrepreneurs, these chaotic times are actually when we can make the most money. When one asset takes a dive, money tends to flow into something else. With risk comes opportunity, and we recognize that during every crisis. I'll be sharing more of what we've learned as investors and entrepreneurs, and I'd love for you to follow along. What do you think is coming next? We're running out of time, so I'll wrap up here. We share free insights on how to become an entrepreneur, investor, and achieve financial freedom. If you don't want to miss any of it, make sure to follow my channel and turn on notifications. Don't hesitate to share this video with others. I truly wish everyone who enjoyed this video soon reaches their financial freedom. If you found even one or two things that could improve your life today, I'll consider this a success.